Okay, so back to a state of normalcy here. Now we're going to talk about another ratio that I can at least walk you through with some confidence, all right? Not like the long-term debt to total capitalization ratio. That one, for some reason, it's easy for me to remember it only because it's so bizarre. So I guess hopefully it sticks out in your mind and you at least know how to compute it, because we're repeating long-term asset on top and then long-term asset again and as a denominator on the bottom. But whatever, that is what it is. But this ratio I actually like a lot, because we were concerned in our long-term debt to total capitalization ratio really with two things: our long-term debt, the amount of money we owe after a year, and the amount of money we actually own. And we kept it simple. We just want to actually understand the relationship between the two. So that's what the long-term debt to equity ratio is all about. So first, why would we want to actually compute this? We've already looked at the total debt to total equity ratio. We've looked at the debt to asset ratio. We've looked at another ratio that I don't really want to talk about anymore. But what's so special about this one? Why would a bank or anyone else be interested? Well, that's because no one can predict the future. Yes, you may be successful and you're able to pay off your bills with your operating income. Okay, so whenever you conduct your business, whatever it is, well, I have to get comfortable saying that. I'm sorry, I'm just so used to doing things alone. But whenever we conduct business, we're going to be selling things, right? And hopefully we're able to pay off our bills with whatever it is that we make. But for banks, they don't want to give us money and then go, oh man, we shouldn't have given them money because that one year was a fluke. Because in year two, when we'd be looking into our long-term debt, we weren't able to generate that same profit. All right, so they would calculate our long-term debt, the amount of money that's due after a year, because forget about that year, this year, it may just be a fluke. That's how I want you to think of this. How much money do they actually own that they may be able to use to pay us back? And when you think equity, especially for bankers looking at this, they really care about your retained earnings, because that's your war chest. Okay, because you may have issued some shares, but what if you already spent it on another investment already? All right, so that may not be cash. Yes, it's your claim, whatever that amount is for your preferred or common stock. Yes, whatever you're able to raise is you own that claim to that money, but it may not actually be cash right away. So your retained earnings, that's going to play a very, very key role here in the equity, especially when we calculate the long-term debt to equity, because that at least has some cash that we may use to take care of long-term debts in case of an emergency. Hopefully we never have to actually see that day, because we are both, well, you especially are a very intelligent business mind, and we're going to be able to make strategic moves that's going to guarantee that we don't have to dip into our equity. But let's just say for some reason we want to talk about it. What exactly does it entail? It's simple. Just your long-term debt, all the money that we owe after a year. Money. Why am I writing this out? I usually don't. Money owed after year. Let's say that is $100,000, because I like to keep the number simple. All right, guys, but again, it's very simple. You're going to find the information on the balance sheet. If a question tries to mix it up and give you a bunch of random characters or account titles, just look for the ones that would be considered long-term debts, long-term liabilities, okay? And then, your professor might try and get fancy and say, hey, we have preferred stock value of this and common stock value of that and return earning of this. You just add all that up. You add everything that'd be considered equity. Let's say our equity is a total of, let's be generous here. Let's say $50,000. All right, it's very simple. You just say 100,000. Take all the money that you owe after a year. Okay, divided by your financial claim to your assets. Okay, and this purposefully would be 2/1, because I do not want to do any complicated math and embarrass myself. Okay, so what's the story that this is telling us? So very simply, it's just 2, and for us, we like to keep things in ratio form. For every dollar that we own, we have $2 that's going to be due after a year. But we want to make this make sense to us. So we can boil it down a little bit more. And it's not a stretch for us. We can say for every $2 that we are going to owe after a year, we have $1 that at least we are confident we're able to contribute in case of an emergency. Okay, so that's how these ratios, that's how they work. Don't just think of the formula. Think of what the ratio is looking at. Think of the characters. Why would I look at equity and then look at long-term debt? Oh, okay, because nothing is guaranteed. And this year it may be good, but next year may not be good. And my bank needs to actually take a look at the long-term debt to equity ratio to see if they're comfortable with it. And honestly, I wouldn't stress too much because you and I, we're pretty good. We're gifted with we're blessed, I should say, with the gift of gab. And we're able to convince the bank of anything at all, but it helps if the ratio is on our side.